Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can understand what we see in the global landscape. Again, as I've talked over the last, let's say, 10 months of this year, economy in the U.S. is doing pretty darn well. That's translated into some good stock market gains, generally speaking, more so in large cap, especially in the S&P 500, which we have participated in. Some laggards this year have been really the small cap marketplace, although they start to seem to be a little bit more on fire as of late. And traditionally, as we get into the last couple months of the year, the last quarter, small caps statistically generally outperform about 75 to 80% of the time, and often by a huge margin. So of course we do have a pretty significant weight in small cap as we get into year end. One of the things that I think is important is to note is really we've seen this correction. We haven't really seen a 10% correction all year. Finally received that 10% correction about a month ago from top to bottom. And generally speaking, things have rebounded quite fast in a significant way. In fact, one of the things that is important for all the investment markets, whether it's the bond market, the stock market, real estate, gold, any of the investment sectors, nothing just goes straight up. You need these corrections. You don't know when these corrections are going to occur, but I can tell you statistically, every year we see about a 10% pullback in most sectors, not just the stock market, but in bonds often, gold, real estate, and so on. It's healthy. It's the pause that refreshes. Ultimately, we received a number of calls on my TV and radio show from non-clients, of course, people that were concerned about, what do you think, Brian? Is this going to be the next recession? Is it going to be 2008 all over? And we really tried to ease people and explain to them that unless you're following a detailed investment strategy, which includes real risk management and really when to sell, which is clearly not now, investors get caught into emotion, and emotion is going to screw up your investment decisions. While I would always like to buy at the complete low, sell at the high, and then things go back down and buy back in and do this kind of crazy trading month in, month out, not realistic. I don't know any firm or any individual who is good at doing that. What I will tell you is this: over the longer term, our clients have been extremely well rewarded, and reducing the major catastrophic risk is really what money management is all about. Of course, as a fee-only fiduciary firm, our clients can sleep well at night knowing that we're doing the best job possible with their portfolio and making sure that we're watching things on a very close basis every single day. As I made a comment earlier, U.S. economy is doing pretty darn well. Emerging markets, generally speaking, most countries are doing pretty well. Europe is still really in a bad situation. We avoid Europe really at all costs, and really we haven't been in Europe for years and years, and I don't plan on going into Europe at all, simply because the growth is just not there. Now, while their market's been beat up a lot this year and negative for the year, generally speaking, relatively weak. Stay away from those areas, not only on relative strength on performance basis, but also economically. The GDP growth in Europe in most of these countries are just horrific, so you want to really avoid these. We continue to be very defensive in our bond position, floating rate securities, short-term duration. Our average maturity right now in our bond positions in our client portfolios is around 2 years or so, which is really a good point given the current interest rate cycle. I'm still seeing a lot of new potential clients that call our firm or my TV and radio show who still are out there stretching for yield, buying crazy investments that have these outstretched yields but are extremely risky. Those need to be avoided. Eventually, as the economy gets better, we're going to see these rates start to tick up a little bit. Not Jimmy Carter days, but I expect rates to move up. That's going to be bad for most bond investors, especially in the high yield market. Really high dividend paying, let's say, real estate investment trusts are paying these crazy leveraged yields, mortgage REITs and things of that nature. So again, anything that's paying an outstretched return or dividend, we're really staying away from, because these are really the riskier assets on the income side. But of course, uninformed investors are jumping into these probably at the exact wrong time. If you're a client of our firm and you have a question, please call us. If you're not a client, call our firm for a consultation. There is a difference, and we do invite you to experience it. Make sure you have yourself a safe and profitable day.